So, welcome back again to our class in today's lecture series on CVPA. Without further ado, you all know that you are in the class, the professional class as organized by Learn City. So, in today's class, we did be looking at computations involving CVPA. So in previous lecture series and lecture slide, we've been able to look at the concept of CVPA definition, what it entails, and so on and so forth. Also, we have been able to look at the assumptions governing the application of CVPA. But in today's class, we'll be looking at computations and formulas in CVPA. Now, there's something you need to get at the back of your mind before we move forward to this computation. One of those things we need to note is a major subset of CVPA is what we refer to as the break-even point. What do we refer to as the break-even point? The break-even point in CVPA is actually the point or the position where the firm, the organization or the company is not making profit and is neither making a loss. So, when the firm is not making profit and is not making loss, that is a situation whereby we have zero profit or zero loss, is what we refer to as the break-even point. So, in most CVPA computation, the examiner will be requiring students or the examinee to compute the break-even point. The point at which the firm will be able to recoup its fixed cost. To approach the challenge or the solving of break-even point, there are basically two techniques. We have what we refer to as the equation technique and the contribution margin or marginal income technique. Now, don't forget, in this section, we are looking at how to get our break-even point. The point where no loss is made, where no profit is made. So, how do we address this? According to the equation technique, which is induced from the mathematical or economics approach, it says that sales at BEP or sales at break-even point is equal to variable expenses, variable cost, plus fixed expenses, fixed cost, plus zero profit. So, the sales or revenue or turnover at break-even point, that is, the sales that the firm needs to make in order to be able to make a zero profit, this is also referred to as sales at BEP. The sales at BEP is equal to variable expenses plus fixed expenses plus zero profit. In other words, plus zero. Or in other words, variable expenses plus fixed expenses equals to sales at BEP. Or this could be written again in an equation form by saying TR. Don't forget, in economics, we refer to that as a total revenue, which in accounting we call sales, equals to total cost. Don't forget, total cost is made up of the fixed and the variable cost. So, TR, total revenue, equals total cost plus zero profit. For example, if ABC Nigeria Limited incurs 100,000 naira fixed cost and 5 naira per unit variable cost, compute the sales at BEP if it produces 10,000 units. Now, there are some things you need to get right. Using the equation format, we say TR at BEP will be equals to total cost plus 0 or plus 0 profit anyway. Now, what's our fixed cost? 100,000 naira. What's our variable cost? Our variable cost per unit is 5 naira per unit. And the question says that 10,000 units is proposed to be manufactured. Definitely, our variable cost will be 5 naira per unit times 10,000 units, which is 50,000 naira. So, in a nutshell, our total cost is what? Is 150,000 naira. So, definitely our sales, the sales we need to make such a way that we are not making profit, we are not making loss. It must be able to cover the 150,000 naira total cost. So leaving us with a zero profit. That is, any sales made below 150,000 naira will actually result in a loss. While any sales made above 150,000 naira would result in a profit. But any sales made at the exact amount of 150,000 naira will be giving us a zero profit. This is what we refer to as sales at break-even point.